In this week's update, precious metals rocketing. Which other sectors should get your money? What you should avoid doing? And why technical analysis is paramount. My name's Garry Davis, and as always, this is general advice only. Please click on the like button if you find this information valuable. Okay, what to avoid? I guess there are a number of things here, and I get a lot of questions from all sorts of quarters about perhaps waiting until things settle down, be that 6 months, 12 months, however long it might be, and it's definitely the wrong way to go about the market opportunity that is with us right now. So waiting for the big drop is certainly something that I think you should avoid, because it may not come at all. There may not be a further big drop, and it almost certainly, whatever happens, is probably not going to happen when you expect it to. So, waiting for some signal from up above is just not a good way to go about it. There are just too many opportunities that are going begging. There's been terrific opportunities in the last few weeks, and there's going to be a lot more opening up as we go forward. The second thing that I would avoid doing is just using the index as your cue to re-enter, as though every stock in the stock market goes in the same direction, because they don't. There's massive divergences, and I'm going to show you just a few of them just to highlight that point. So absolutely do not use the index as your guide as to what you should be doing. This is it's been a stock pickers market for quite a few years, but never more so than now. And if you're seeking a degree of safety while still being able to get a decent return, then you achieve that by zeroing in on the stocks and the sectors that are going to be the outperformers, not by going the traditional, conventional thinking route of, well, I'll just diversify. I'll just own the whole market, which to me is an absolute rubbish strategy, because it guarantees that you will own underperforming and poorly performing stocks. And what is the sense of that? So this is absolutely a stock picker's market. So you need to toss out all conventional wisdom about how you should go about things in the market. It's been the case for probably a decade, but never more so than now. And the final thing to avoid, amongst many, is needing to understand why. I get a lot of questions from all sorts of places about, well, why did the market do this? Because that doesn't seem logical. And the price action can defy logic for a number of reasons. First of all, the market's trying to price in the future. And we've got a future that's got multiple perceived outcomes, and probably multiple realistic outcomes as well. Also, the human psychology goes through cycles of being positive and negative. And so which part of the cycle, the human psychology cycle, are we in at the moment? And it changes. It can change even intraday within a session. And then over the top of all that, we've got computer algorithms that are just doing their thing. And their aim is actually to promote volatility, because they're just trying to make money in the short term, often on a daily basis. And so if they can promote volatility by stimulating the market to go in certain directions for short periods and then reverse suddenly and go in a different direction, then they can make profit out of that. And then finally, what's the impact of central banks and governments to prop up the market? It's now a matter of public record that the Japanese government the Japanese central bank is one of the largest participants in the Japanese stock market. And to what extent does that apply in America or in Europe? I don't know the answer to that, but I suspect that it's going to continue to play an increasing level. So needing to understand why is really a fruitless exercise. It's very much about respecting the price action. So let's move on to American stocks. The index fell by 1.3% last week, but did finish nicely on Friday, and it was the first Friday in about 3 weeks that the market went up. Now, I think the actions of the Fed, particularly in the first or so week of April, has probably taken a full retest of the March lows off the table, because the stimulus uh, that they've developed, or the government has developed, is just so extraordinarily massive that liquidity, I think, is probably going to ensure that the market doesn't revisit the lows, and that certainly would be Trump's strategy, because the last thing he needs, this year leading into an election is bad enough, but the last thing he needs is for the stock market to drop into a bear market as well. So he and the Fed are going to be doing everything they possibly can to keep the market up as high as they can. However, we've had an amazing rally, um, and a pullback of some sort is almost certain to happen. So I certainly wouldn't be chasing the market in general at this level. There are still stock-specific opportunities, stocks that haven't yet rebounded yet. And I introduced a few of those to members yesterday. But there will be a pullback of this rally. So there'll be even more opportunities in coming weeks and months. So the question is the market pricing in too much of an improving future? Because, people are starting to see the virus curves flattening, and they are seeing, the death rates tailing off. And there's a lot of groundswell of opinion now that this lockdown has perhaps gone too far, that it's certainly done its job, and that we need to be, focusing on not further destroying the economies. So the market is pricing in some of that, but is it priced in too much? We're just at the front end of the US earnings season, and I guess that's probably delivering sort of what the market expected, but a lot of companies have pulled their guidance, and so there's still a lot of uncertainty around where the earnings will be. So for me, we can only be guided by the price action. If you try and rely on the fundamentals and logic, then you're probably going to be sadly misled, I think. So price action is paramount at the moment. And I think the result of all that will be a broad trading range, is the most likely outcome, perhaps for the rest of this year. Now, I'm talking at the index level, and I'll show you a bunch of charts in a minute that will sort of reinforce the incredible divergence that there is in the market. And for a start, the Nasdaq presents a bit of a different picture to the S&P, because stocks like Amazon and Netflix have done incredibly well, and so a lot of the tech-heavy stocks in the Nasdaq have caused the Nasdaq to be an outperformer. The US dollar consolidating, it's moved up a little bit during the week, consolidating just around the 100 mark. And the 10-year yield was steady at 0.62. So let's go and look at some charts. We'll start with the S&P first of all, and you can see where we're certainly seeing some signs that the S&P is running out of a little bit of steam. We've had a little bit of a pullback and haven't really broken to new highs in the short term. You'll notice that we're currently sitting between the 50% and the 61.8% retracement levels, which certainly indicates a good level of strength. We've made it back to the 50, but the market seems to be, or the index seems to be, struggling to get through that 50-day moving average and have a run at the 200-day. And I suspect that we'll probably see some sort of pullback before that happens. But if you look at the NASDAQ has actually done better. You can see that it's actually trading, it's gone through the 50 and the 61.8, and it's trading up higher than that. So the NASDAQ definitely an outperformer. And let's just have a look at some of the divergences. So these aren't recommendations at all, because they've gone too far. But just to point out the divergence in the market. So here's Amazon at new all-time highs. Here's a company called Abbott Laboratories, which is also trading at new all-time highs. Here's Alibaba, one of the best stocks on the planet, I believe. didn't really dip very much and is not that far off all-time highs. This is Shopify, a technology stock in America, new all-time highs. We look at the biotech sector, has been a real outperformer in the States, almost back to all-time highs. Now, would you rather own stocks in a sector like this, or would you rather own stocks in a sector like banking and finance, for instance? You know, take your pick, that or that. It's pretty obvious. And the headwinds for the banking sector look as though they're going to be fairly severe for a long period of time. So this is probably exactly what this sector should be doing. Now, I'll also point out energy, which has also been smashed for obvious reasons, because there was just an incredible event last week where the price of oil in the futures market actually went negative. But this is the energy sector. Now, this is a little bit different because this is a sector that I think has just gone through an event that we'll probably not ever see again. And so this is probably lower than it otherwise would be because of that event. And so I think it presents the potential for a shorter term trading opportunity. It's definitely not a long-term buy in my view. Too much uncertainty and too much geopolitics going on as well. But certainly perhaps a trading opportunity in the energy sector. And just while I'm here on energy, this was the event that that I referred to, where the near-month futures contract in oil because there's effectively no storage to be had anywhere around the world. Traders had to basically sell oil futures contracts at a loss, and they sold them down to as low as negative $37. So in other words, they were paying producers to to take that contract off their hands. Quite an extraordinary event. Now, we have rebounded a little bit, and I'll talk a bit more about that when I get to the oil sector. But an incredible divergence between different stocks and different sectors. So, as I said at the start, you don't want to be thinking about this market as a single entity. And do you either go into it or not go into it? It's a far different picture to that. Let's look at, this is the US dollar. So we moved up very slightly. And while I'm here, there's the Australian dollar. So it's been on a pretty big roller coaster as well, and showing some strength, which is really, I guess, a bit about expectations for stimulus in China. Okay, moving on to the Aussie stocks now. So 63.8 is where we finished. Our index fell 244 points on the week, 4.4%. In the Australian market, I think there are really three broad opportunity types. There's the undoubted quality stocks that have got very, very strong balance sheets. They've got robust cash flows, and they've got high visibility over sales for the next few years. And they're also in sectors that I call enduring growth sectors because they've got tailwinds that are going to prevail no matter what. And we're talking technology, we're talking about the environment, renewable energy, precious metals, innovative healthcare. There's a number of sectors that are going to have undoubted tailwinds, whether we've got a virus, whether we've got a lockdown, whether we've got a war in the Middle East, no matter what else is going on, those sectors are going to continue to grow. So that's one opportunity type. And it just requires a great deal of detailed research to identify the stocks that are going to be the winners and those that are going to be the losers in that sector. The second opportunity type are stocks that are just become massively oversold and almost certain to rebound. And I mentioned the energy sector before. The price of stocks like Woodside or ExxonMobil, for instance, are probably at levels where a bounce is probably a pretty likely thing. But there are other sectors as well. The gaming sector has effectively been shut down, at least the bricks and mortar gaming sector. But once the economy opens up again and life gets back to some sort of normality, gambling is a very defensive sector. So, there's some tremendous bargains in that area as well. And also, if you look at luxury brands, now they're absolutely on the nose at the moment because no one's buying much of anything. But luxury brands prevail through thick and thin. So, there are areas that are tremendously oversold and justifiably in the short term, but they will rebound when the economy opens up again. And then, of course, we've got specific stocks that have just stayed incredibly strong. And, I've mentioned a few of those over recent weeks. So let's just look at the ASX 200. So you can see, as opposed to the S&P, so if we're just looking at the index level, so the S&P in the States has rebounded to about here, between the 50 and the 61.8. The NASDAQ is up here, and yet the Australian index is down here. Now that's largely because of the drag provided by the banks and by our major energy stocks. So in the Australian market, the banks and the energy stocks form a much higher percentage of the total than they do in America. And so that's why our index is lagging so badly and probably will continue to lag. But nevertheless, in Australia, there are terrific opportunities. You've just got to know where to find them. Now, precious metals, gold was up another $44, so it's been a huge 2 weeks, and it finished at $17.28. And the sector is doing everything that I hoped it would do, and I spoke about this in detail last week. Now, gold, before it did end up surging net $44, did drop into the support zone that I'd identified between 1630 and 1670. So that was just a normal sort of garden variety pullback, pretty mild, and then it bounced very hard from there. There is an increasing focus on safe havens around the world. If you read a lot, you can just see it everywhere. It's the fear of the unknown. It's what people can see now with the economic destruction, but it's also the fear of, well, what comes next? How bad will this be? How long will it take to bounce back? And what will be the impact on equities? What will be the impact on bonds from all of this central bank buying of bonds? The complete distortion of price discovery. And complete destruction of what would normally be called the risk-free rate. So increasingly, people are going to be looking for other safe havens, and of course, gold comes into that. And then we've got central bank debasement of currencies. That more and more people are going to start to understand that the purchasing power of their currency is just getting trashed, and they're going to have to look for alternatives. We've got institutions which are disastrously underweight gold and silver by orders of magnitude. That they really should be many multiples of where they are at the moment. And I think institutions are now certainly coming to that realization. And to top it all off, the gold and silver sector is absolutely minuscule compared to the size of the bond market and the equities market. If only a relatively small proportion of money came out of the bond and equity markets and looked to move into the safe haven of precious metals, it's just no telling where the price could go, because it's just such a small sector relative to that weight of money. Now, turning to precious metals, GDX finally broke out. We've been looking at this setup now for probably 3 years. Broke out in a very decisive technical event, which in itself is important because that brings in technical traders big time. And what was more meaningful about it is, we often see gold stocks or gold moving on some news, and generally those sort of moves are not sustainable. They tend to be fairly fleeting. But when you see a major decisive breakout on the absence of news, or in the absence of news, then it makes it all the more meaningful. It just shows you that this is not a news-driven event that's just brought speculators in for a short period. this is a new tide of money, of investing money that's going to stick around. So it's very, very decisive and very meaningful. And the final point I want to make here is that the GDX to gold ratio, or GLD, which is the ETF that tracks gold. So in other words, the ratio between gold miners and the gold price itself is roughly half the long-term average. Now, that is not sustainable, as you'll see on the chart, and there will be some form of reversion to the mean. Now, whether it starts immediately or whether it takes some time to achieve, it is going to happen. And if we've got gold moving up at the same time, then GDX has really got to massively outperform to catch up. So the opportunity in the gold market is probably as good as I've ever seen it. So let's take a look at the gold price. So there's the gold price on a weekly. We've been looking at this this channel that started forming at the end of 2018. It's gone up very, very steeply. Gold at the end of or the start of 2019 was trading at about 12.25. We're now at 17.28, and it's gone up very, very sharply. We've got some overhead resistance, which is going to kick in just a tick under 1800, and then we've got the all-time highs just over 1900 as well. But I see no reason why this trajectory cannot continue. If we look at it on a daily, you can see that it's we're getting quite small and brief pullbacks each time. So this was only 2 days. This was really only 3 days. So they're very small and very shallow retracements in the gold price. Turning now to GDX. So this is GDX on a weekly. And if we look at this big picture setup, so I'll just remove that just to clear it up. So this is the big base that's been forming, which really started about 7 years ago. We had a really strong run up in 2016 that petered out, and then we went into a much tighter consolidation range. We moved up to a higher level, and then we got this liquidity-driven crash that only lasted 2 weeks. So I think it's reasonable to just ignore this, because this was really just a forced event that only lasted a couple of weeks. So if you take that bit out, take that little tail out for a couple of weeks, then we've had a consolidation, we've moved up, we've had another consolidation, and now we've finally broken the peak that goes back to August of 2013. And as you can see, we broke it really quite meaningfully. And you can just see here, the peak of GDX in 2011 was up at $66. Now the gold price, as you would have remembered from the last chart, is within striking distance of its all-time highs. GDX is nothing like it. It's still only sitting at 34. So it's about half the price that it was compared to 2011. Okay, so now let's look at a couple of other charts. So first of all, this is the spread. This is the division between GDX and GLD. Now, this only goes back to 2006, which is when GDX started. But there is data available using a prior index, which was the HUI index, which goes back many, many decades. And the long-term ratio between these two instruments sits around about here. That's about the long-term ratio, so about 0.45. We're currently sitting, as you can see at the moment, at 0.21. So there's a lot of catch-up for gold stocks to catch up to the gold price. So the other way of saying that is that gold stocks have never been cheaper relative to the gold price. Now you can see there's been a real surge in the ratio in the last little bit. And if we look at the next chart, which is basically the relative performance of GDX relative to GLD, you can see that the gold stocks really have outperformed massively since March, or since the lows in March anyway. So that's our situation with the gold sector. I think this is a real generational opportunity in gold, and I'm certainly going to be putting a great deal of focus on this in both my services, portfolio analyst, and also the Insiders Club. Okay, turning to other commodities, copper eased to $2.31. Yeah, the long-term outlook is positive, but the short-term, obviously not so much. Crude oil absolutely collapsed completely. As I said, the futures market went negative, but interestingly, the spot crude finished at $17.25, and the May futures are trading at around $15. So the fact that May futures are not trading lower for the same dynamic that occurred with the April futures says that the market's expecting supply to fall and for there to be some sort of return of demand. Otherwise, the futures wouldn't be trading where they are. So I think we've probably seen the extreme lows in crude oil, and some stocks have probably been disastrously oversold. So a bit of an opportunity there. It's a trading opportunity. I don't think it's an investment opportunity, but certainly a trading opportunity. There's the spot copper chart. As you can see, moved up a little bit, but is probably going to stabilise around about this area, I suspect. So just my final thoughts to wrap it up. We're not out of the woods yet by any stretch of the imagination, but there certainly is plenty of lights glowing at the end of the tunnel, and I think that's what the market has responded to. Most people still expect a retest of the lows, and a lot of people are still sitting out of the market waiting for some sign from heaven. But don't do that, because I think we're in an environment where historical patterns and seasonality may not apply. There's the old adage of sell in May and go away. I wouldn't do that either, because there's some terrific opportunities at the moment. Just focus on the best stocks in the sectors that have got those long-term tailwinds and have got those long-term tailwinds in spades. Recognise that there are always pockets of opportunity no matter what. We saw that with stocks like A2 Milk in Australia that didn't fall at all, not even a day during the crash, and now are trading at new all-time highs. So there are always pockets of opportunity. And I think overall, focus on where there is current outperformance. So pay attention to the price action. There's logic and fundamentals are not meaningless, but they're just less important in this environment. It really is all about the price action. Portfolio analyst this week coming. I've got another really outstanding local growth stock to introduce, and also quite clearly there'll be plenty of focus on gold and silver. So if you want to find out more about what I do, if you'd like to contact me, there's the website with more details about the services I provide, and there's my email address. So that's it for this week. Cheers.